Next guest is an expert. He expects more volatility ahead for the loonie. Karl Schamotta is chief strategist at Corpay. Thanks a lot for coming in.
Absolutely. Great to see you.
I'd love to get, first of all, your take on this morning's retail sales numbers in the United States. How do they affect your outlook on U.S. inflation and ultimately U.S. rates?
They were sort of a Goldilocks print, right? We had stronger than expected results both in October as well as September. We had an upward revision in the September number, which really puts us on track toward a relatively robust fourth quarter for consumer spending. And that ultimately is something that adds to that level of excess demand in the U.S. economy. It does keep sort of a floor under inflation rates. It keeps the Fed maintaining a relatively hawkish rhetorical posture, and ultimately it sets the conditions in place for an economy that continues to outperform relative to expectations. All that said, that is something that creates volatility in markets because we're watching all of this through the lens of what might happen to interest rates in 2024.
The Canadian dollar very much affected by perceptions of rate differentials. Which central bank, the Fed or the Bank of Canada, is going to raise rates the most or the fastest, or cut them the most and the fastest? Has that dynamic changed, those perceptions changed since the inflation print of this week in the U.S.?
Hugely, yes. We've had a massive change just over the last 24 hours. Essentially, markets moved to put the Bank of Canada and the Fed on close alignment through June, July next year. So both central banks are expected now to cut twice by June next year. And the Fed is expected to outpace the Bank of Canada toward the end of 2024. So they're expected to deliver 4 interest rate cuts against the Bank of Canada's 3. That's actually helping to lift the Canadian dollar. That is probably a little bit of an overreaction in my opinion, but it has definitely helped to ease the situation facing the Canadian dollar, both on the rate differential side, as you highlighted there, as well as the fact that if we lower global interest rates and we lower global borrowing costs, that actually relieves some pressure on Canada's exorbitantly over-leveraged private sector, right? When we have households and businesses which, fundamentally rely on the price of global money, when that price falls, that actually does help to brighten the outlook a little bit, at least for Canada.
If I understand correctly, you think the loonie rises to about 75 cents in the shorter term. Tell us more about your outlook for the loonie.
Yeah, so we're thinking that the U.S. dollar, firstly, of course, was very much overbought going into this latest inflation report. We do think that economic data is going to continue to soften over the next couple of months, with everything from labor market conditions to retail sales beginning to sort of disappoint relative to expectations. That should mean that currencies outside of the U.S. dollar get a little bit of relief. We should see the Canadian dollar rally a bit on that. Not massively, as you alluded to there. We might see a couple of cents here. However, early 2024, the shoe should begin to drop for Canada. We should begin to see the same thing happening here, really as the U.S. slows and as the impact of the last year of rate hikes really hits the Canadian economy. Then we should see the Canadian dollar begin to fall back, and for expectations for the Bank of Canada as well as the Fed to come into closer alignment.
You referred to the over-leveraged Canadian private sector. Does that include Canadian mortgage holders? And
yes.
Does that include the wave of renewals that are coming over the next several years?
Yes, it does. And I think that's the real key thing here is, although we all watch the Bank of Canada very closely, the reality is that the global price of money that is transmitted into mortgage markets that banks rely on for funding, that rate is set outside of Canada. And so if we see this sort of drop in global yields, that is providing some support. But the reality is we're still looking at rates that are far, far above where we entered the pandemic and that post-pandemic period. That is going to expose householders to massive, massive costs. That should ultimately lead to lower consumption, to households sort of, counting their pennies a little bit more than they have. And that ultimately should lead to a slower Canadian growth pattern.
Has all of this shoved the price of crude oil to the back burner in terms of an influence on the Canadian dollar?
Oh, absolutely, yeah. So we've had a couple of big developments in the last decade, right, that really led to this. First, the Canadian economy changed and sort of rebalanced toward being focused on housing investment, on consumer spending. But the other big factor, of course, is what has happened in the U.S. The shale revolution, the emergence of the U.S. as a global oil producer, especially on the marginal side, that has meant that the U.S. dollar is now correlated with crude prices in a positive sense. In other words, it rises when oil prices go up. And so essentially the Canadian dollar is now much more exposed to shifts in global financial conditions and overall risk appetite, and much less to what is happening to the crude price.
Karl, thank